Hi, we're talking about Your Money Matters, and this is NDTV Profit. Well, on this program, we speak about everything personal finance related. We also speak about mutual funds. And on this program, we like to bring the people who manage your money on so that you can understand how they're looking at risk assets, how they're looking at the markets in general, not just equity markets, but the fixed income market as well. And so that you understand how to tactically set your investment strategy. Joining me today at the start is Ramesh Mantri, the CIO of WhiteOak Capital AMC. Ramesh, absolute pleasure having you on the program, and I think it's a crucial moment that we're speaking today because some investors who have gotten in over the course of the last 12 months might have their confidence shaken based on what we've seen in the markets over the course of the last 5 months. We've seen the benchmark fall 5 months in a row, which is something we haven't seen in practically 30 years. So how you're positioning yourself and your portfolio is going to be absolutely crucial and key from their perspective as well. So first of all, thanks for joining in. Let me ask you about your Balanced Advantage Fund, because this really is going to give me a perspective of how risk on, risk off you are.
Yeah, so on a Balanced Advantage Fund, the neutral equity exposure is 55. As we speak, we are running more than 60, which is at least 10% overweight and neutral. So our model is clearly indicating that there is clearly now an opportunity to allocate more to equity. And in fact, it's the highest in the last 2 years that the model has indicated equity allocations in the portfolio.
Okay. So help me understand this model as well, right? So as I understand it, your Balanced Advantage Fund would go to a minimum of 30%, but largely it would fluctuate in that range of closer to 60, 65%. Is that the right understanding?
The neutral level is 55, which will be closer to 55. So as we speak, we are running it at least 10% overweight the neutral level.
Okay. Okay. So the interpretation of that, therefore, Ramesh, is that you are far more sanguine, you're far more comfortable with the valuations of the equity market as they stand right now. But is that true across the board, or are there still pockets of too much froth and areas where you are avoiding?
Yes, so clearly it's not that the opportunities across the board. I think the large caps are clearly attractive, at these valuations. And by the way, the Balanced Advantage Fund the portfolios are by definition more tilted towards large caps. So that's the most attractive part of the market. I think there is still, while small caps and mid caps have corrected more than large caps, but I think still the valuations are not. So the large caps is in the green zone, the mid caps is in the yellow zone, and the small cap I would still say is in the red zone, from where we see more opportunities at an aggregate level.
Okay.
In terms of sectors, I would say again, some of the sectors that did exceedingly well in the last 3-4 years, whether it was stocks in industrials, defense, number of PSUs and all, which many of them tend to also to be cyclical businesses, where I think the valuations are still not very attractive for many of them. So it's not that it's attractive across the board. Remember, a lot of these stocks and sectors are done exceedingly well in the last 4 years.
So some correction was warranted, but some people are also calling the bottom, as difficult as that is to do. But at least they are venturing out, as you seem to be, to buy more. I'm just wondering, since the approach that you have is completely bottom up in your equity strategies, what are the aspects that you're more focused on at this juncture? Because Q3, for a lot of companies, even the ones that you invest in, was not very good. But the narratives that seem to be building now is that perhaps even from the earnings perspective, while Q4 may be a little wobbly, Q1 of the new financial year is when things will really take off. So from that perspective, even in your flexi cap and your mid cap fund, is this the opportune moment to build on positions that you have?
Yes, so first, see, Q3, we were seeing a significant economic slowdown, and that was playing out both in consumption and capex, right? And since then, we are seeing now a shift in government stance. Clearly, the budget is very strongly supportive of consumption. The shift in the budget is happening towards consumptions and less of capex. And then, of course, now the monetary policy support is coming through by the RBI to support growth. So I think there are a lot of steps being taken to get growth back in India, which had slowed down in India. And the incremental data shows that there is some green shoots out there. I think one of the things we have to call out very clearly is the last 3-4 years has been supported by very strong government capex growth. That is not going to be such a lever of growth anymore. And certain sectors, stocks benefited from, in fact, did tremendously well the last 4 years. The expectations in some of those stocks and sectors are way ahead of what is possible. So there is a reset happening, clearly. And then, of course, there are parts of the market that are very attractive.
In your flexi cap fund, and I really look at this as the blueprint of how you're going to manage your equity strategy, because the canvas is blank. I have access to the fact sheet from the end of January, and so maybe I'm not up to date. So maybe you can help me with that, because even in the month of February, you saw massive drawdowns at all levels. So at the end of January, you had 57% allocation to large caps and close to 27% towards small cap, 12% was in mid cap. Has that changed materially, Ramesh?
It hasn't changed materially. Of course, small caps and mid caps have seen bigger drawdowns in Fed. So there's an automatic rebalancing of some weights have happened. But we have not taken explicit stance to cut back on small caps or mid caps and raise weights to large caps. That is not the explicit strategy. As bottom-up investors, we still continue to find opportunities both in small cap and mid cap that are attractive. But when I'm saying that the small cap is still in the red zone, it's at an aggregate level and not at an individual sector stock level.
Oh, that's very interesting that so can you build on that a little bit so that your investors and prospective investors can understand what you mean when you're going out and you're venturing out in a space where a lot of your peers have veered away from and are saying that it's egregious in certain cases, the valuations, and they are bound to correct. They have. You're still positioned quite strongly particularly in the small cap space.
Yes, so if you look at the Indian market, there are, if you exclude just the large cap and the mid cap, there are over 800 companies with a market cap over 1,000 crores. So first, there's a fairly large universe that is outside large and mid, where funds like us can invest in. So from that, finding 50 companies which are attractive is not such a challenge. If you ask me about the 800 as an aggregate basket, I think there are challenges there. But finding a few stocks, 5% of that opportunity as being attractive, that is always there, bottom up, as a bottom up investor.
Okay. And I think it's important to reinforce the fact that you are not bound or you are not pushed because of your assets under management to venture further and further out. This is a conscious call that you are taking because you have very manageable assets under management. You have 120 stocks as per the data I have available to me in FlexiCap, and you have less than half of your portfolio in the top 20. So you've actually ventured out and you've put a substantial amount of your money in those wider universe stocks. So what are the biggest opportunities that you are currently seeing? And the reason I ask Ramesh is, and let me remind my viewers also, that at the aggregate level, if you've seen the small cap 250 index, for example, fall 25% or thereabouts from the high point, the individual stocks have fallen significantly more, and quite a considerable portion of that has actually fallen more. So Ramesh, what opportunities are you seeing, particularly in the broader end, and how are you going about deploying?
Yeah, that's the key point that first of all, while the indices have fallen by 25%, the median stock has fallen more. In fact, in fact, I would say the correction, the sell-off that happened in the month of Feb was indiscriminate. It did not distinguish too much between quality companies and not so, and poor companies. So that actually creates an opportunity for, fundamental investors to actually start reallocating and realigning their portfolios. That if a poor quality company and a good quality company fell at the same rate, more or less the same rate in the market, there's actually an opportunity to reposition your portfolio. So we are, even as we speak, I'm just saying in the month of Feb also, we have relocated to other stocks which we find more attractive. So there is no explicit stance that we have cut back on small or mid. It's just that some opportunities that you couldn't invest earlier have started emerging because of the broad-based sell-off that has happened in small and mid.
I also find it very interesting. Please correct me if this has changed, because according to the fact sheet, your allocation in your mid-cap fund as well was about 69% towards mid-cap, and you've utilized the regulatorily allowed limit beyond the mid-cap to actually allocate 16% in small cap, which I find quite interesting. Can you take me through why you've done that?
We are clear stance. Our mid-cap fund is largely mid-cap plus small cap. That's, our stated, stance on that. And by the way, you want to invest in mid-cap fund into small caps, which become mid-cap, So there is always going to be every 6 months when the index, the definition gets revised, a number of small caps become mid caps. So you actually want to invest in them before they become mid caps, not long after they become mid cap. That's where the alpha is. So clearly, we as bottom up investors continue to find those opportunities. And I would say, if you're a bottom up investor today, I think there are interesting opportunities have started emerging in small caps and mid caps.
Okay. So often when I call CIOs and fund managers onto this program, I try to ask them to address their investor as well. And it's important for investors also to benchmark expectations and set their own ideas as to what can be expected. From your perspective, heading into the rest of this year, what should the investor anticipate? Because it's a period of unprecedented volatility on the global stage as well. So what should the investor bear in mind?
No, first of all, we've seen extraordinary 4 years after COVID in the markets, where volatility was low, overall returns were much better than long-term averages. I think the most important point as an investor you got to know is equity markets cannot deliver better returns than corporate earnings growth, which longer term is correlated with GDP growth. So at the end of the day, the long-term Sensex returns are only 12%, which is where the nominal GDP of the country is. So whenever you get much higher returns, you are either over-earning and there's going to be some payback time. And because the volatility was so low in the last 4 years, I think a lot of people got lulled into the idea that you could make 18-20% returns with very low volatility. And of course, equity has better taxation. But I think the volatility has emerged because there was a lull for 4 years. Now the volatility is much bigger. There are catalysts in place for volatility. There is geopolitics. There is the new US administration. There is the dynamic of local politics where we are back to a coalition government. And the fact that we are seeing, after a very strong economic recovery after COVID, a slowdown in Indian market economy. So the markets have clearly moved away from a flat pitch to a turning pitch. And the skill required to play the game on a flat pitch is very different from the skill required to play the game on a turning pitch.
So moderate expectations is best, and to reset your expectations lower. Point well made. Ramesh, pleasure speaking with you, and I look forward to our next chat already.
Sure. Thank you, and thanks a lot. Have a nice day.
Wish you the same.